Today is July 22nd, 2015. I wanted to get a quick video off about what's happening in the precious metals markets and in the currency markets. This here is a chart of the US dollar index, and as you can see, it's still at elevated levels here. This has to do with the continued threat of a rate hike by the US Federal Reserve. Just recently, Janet Yellen said that they probably will raise rates in September. So this strong dollar rally continues. And the US dollar has an inverse relationship to commodities prices, as commodities are priced in US dollars around the world. And so a stronger dollar makes commodity prices lower. And you can see this across currency markets as well. This is the Japanese yen continues to show weakness, and the US dollar strengthened considerably against the euro and many other currencies as well. Some of the weakness in the euro is directly related to the Greek referendum and then the agreement that they made with the EU creditors, which I believe is not going to hold, as they can't continue to take on more debt just to pay off the interest of their loans. They're coming to a point of no return here. And anyway, so a lot of that led to strength in the US dollar as well. And this has also led to weakness in the gold and silver markets, and actually across the whole commodity sector in general. I believe the commodity index is now standing at a point that hasn't been seen since early 2000s. But the weakness in the gold and silver market were, in my opinion, directly related to overt manipulation and dumping of futures contracts on the market. You can see here this drop in price. This 100,130 area has held numerous times over the last couple of years. You can see that right there around this area. But on July 20th, let me see if I can zoom this out for you. July 20th, when Japan was on a holiday, and it was Sunday evening in the United States, Asia opening, a classic bear raid ensued. Somebody dumped, or a number of people dumped, over a 2-minute period of time, $2.7 billion worth of gold. In Shanghai, the average trading volume is around 30,000 contracts, but on this day, more than 3 million contracts traded. And then it bounced from there. It bounced from this 1,088, 87 level and went back up here. And then again, I think about half a billion dollars were dumped to keep it low over a very short period of time again. And the type of order that was used here is called a market order, which means sell it at whatever cost. Anybody who's traded on the market knows that you don't, especially in volume, you don't put market orders because you will get a bad price. If you wanted to sell a bunch of goods that you had, maybe a Rolex watch, if you had a number of Rolex watches, you wouldn't put give me whatever you can get for price on it. You would try to get the best price possible, and this is not the way to go about it. And the only reason why somebody would execute market orders like this would be to actually move the price of it down. Well, who would want to do that is a good question, and that's the $64,000 question, or in this case, the $2.7 billion question. And I want to show you some charts of these two banks, JP Morgan and Citibank, which have increased their commodity derivative exposure exponentially over the last couple months, which they may be the culprits for this move here. Another news point that most likely also led to weakness in the market was the announcement by the PBOC, the People's Bank of China, that they increased their gold reserves by only 57% in 1 month. Now, they hadn't updated since something like 2009, and many were expecting that increase in gold reserves to be many hundreds of percent higher than what they announced. Now, China does not allow exports of gold, and they're one of the largest gold mining countries in the world. And they also have imported many thousands of tons. And you can see this with the Shanghai Gold Exchange and from export declarations via Hong Kong and some other port cities as well. But what they do is they have a sovereign wealth fund, and they have state banks that can actually hold it before moving it to the People's Bank of China's balance sheet. So they can hold it off balance sheet, and then they can announce to the world when they want to a higher gold reserves. And many people were expecting an announcement like this because they're applying to become part of the SDR basket and have a larger say, a larger vote in the IMF affairs. Now, at the same time, they're also creating their own parallel banking system with the AIIB and with many different currency swaps with nations around the world. But it seems to me that they are still wanting to extract as much wealth as possible from their trading partners, the United States and Europe, and they're not ready to to dethrone the dollar as the reserve currency of the world. And they want to accumulate much more gold and silver, much more oil and land around the world than they have right now. So they're putting it off by keeping it on the sovereign wealth fund balance sheets and the people's on the state banks balance sheets as well. And by not announcing their true total gold reserves, they're playing by the central banks of the world handbook, which is you downplay the importance of gold and at the same time accumulating as much as you can, which may help their entrance into the IMF SDR basket. And now for some good news. This is the price of silver. You can see it's barely moved even under this pressure. Here's the July 20th dump. You can see the volume also was very, very high, but it was met with immense buying power, which made the move not so large. And it's holding its own right here. Now, we already know that silver is below the cost of production for all primary silver mines, and it's also low on many other mines. We also know that we're coming into a strong deficit where the silver that's actually being produced doesn't meet up with the consumption of the world. And we're coming to an inflection point here, that's for sure. On the supply side, we're seeing already major delays. The US Mint actually has shut down production of silver eagles as they haven't been able to keep up with demand. They will open up, or they're saying they're going to be opening up later this month, and then they're going to be putting their primary dealers on allocation, which means they're going to set aside a certain amount for each of their dealers. We'll see how that goes. But you're seeing delays across all product, especially in large sizes, at least a couple weeks right now for major orders, large orders. If this price stays low, the longer this price stays low, the more silver will be taken out of inventory, and it will lead to a shortage. The price either has to go up, which will slow demand perhaps, or we're going to go into shortage. If it continues at this price point, I believe we'll be in shortage probably sometime in August. And that could lead to an absolute capitulation on the paper side, which brings me to another point. The open interest in the futures silver market is the highest that I believe it's ever been, which means more people are standing for delivery, and there are more people that have locked in their price, which may be another reason why they're trying to move this down as well. The whole annual global production amount has already been locked in for sale via the futures market. And there's only a small fraction of that that is actually being held in the futures market depositories, their warehouses. Anyway, so while it's definitely disappointing to see gold break below a major technical support level and continue on in this multi year downtrend, we are coming to some sort of resolution here soon. Now, it may go down further, but that will only increase the tightness on the physical side and the delays in delivery and make for a much more violent, robust move up later once that comes to some sort of resolution. And from a fundamental point of view, things have only increased. If you just look to Greece as an example, for many weeks, the Greeks were limited to being able to take out 60 euros per day. Just recently, they were able to increase it to 450 per day. But the people who had their wealth stored outside the banking system in a tangible asset, they were able to continue on buying goods and services, taking care of their family. And if there was to be a greater crisis in Greece, for example, they defaulted on their loans or they went back to the drachma, then the people who had their wealth in the tangible gold and silver would have come out unscathed and maybe even perhaps in a better situation. So, from a fundamental point of view, nothing has changed. Things have only gotten undervalued more, and it's become that much of a better deal. Well, if you have any questions or comments, please let me know. And you can also go to the link here at my site, which will have some links to the details and articles related to the commentary in this video.